This video, we're going to run through the different order types and how to place trades. So we'll talk about leverage as well. So first thing we want to look at is how to place spot trades. So like I said, we recommend trading only in spot until you understand how to use it and want to move on to trading on perpetuals. All right, so here we're on Bitcoin spot market. So what you see on the right hand side is your account details, your balance and everything. So it'll show you how much US dollars you have and how that's broken down, and then also your collateral there and different things like leverage, position leverage, fraction, margin. You can ignore all of this until we talk about the leverage side of things. I just want to show you how to buy and sell actual Bitcoin, spot Bitcoin itself. Okay, so you've got two options when buying and selling Bitcoin. We'll just zoom in here and you can see at the moment the price is 33,683. So if you wanted to buy Bitcoin, right, say you thought that the price was going to go up and you wanted to buy it, you would come down to this tab here. All right, so here's where you buy, here's where you sell. You using this little tab here can toggle you between the advanced order form, which is this one, and the regular order form, which is this one. Okay, so we'll just cover the regular one first, and you look here and you've got two options. You can either buy immediately using a market order, or you can put a limit order in and set a price that you want to buy Bitcoin at. Okay, so by coming down here, you go to market order. Okay, market order means that you take whatever price is available in the books at the time of hitting buy. Okay, so a market order is a taker. That means that you're the person who's taking liquidity, and the opposite to that is a limit order where you're the maker, which means you're providing liquidity. All right, so you see here on the left hand side you've got the order book, and you can see each price. You can see there's 6, 9, 4, 5, 7, 8, 9, right? So the whole way up and the whole way down, you've got what are called asks and bids, or offers and bids. You can see, for example, here this moves quite fast, but you can see, for example, here that at 695 there's 216,000, or there was $216,000 worth of Bitcoin for sale at that price, essentially. Okay, so that means that people want to sell Bitcoin at that price, and they've put limit orders in, and a limit order will always rest on the books. So it's called a resting order or resting liquidity. It will rest on the books until it gets filled. Okay, so it's also known as passive flow. So if it's passive flow, it means that it's sitting on the books waiting to be filled, and it gets filled by active flow, which is somebody coming along and saying, I need to buy Bitcoin now. I don't care what the price is. I'm going to just buy one Bitcoin and hit submit. When somebody comes along and does that, that price then goes through the book here and fills the full order at the best price possible. So simple example, if you put a limit order in for 33,699 and you wanted to sell one Bitcoin, you can put it on the books. Okay, so then there's one Bitcoin on the books at 33,699. If somebody then comes along and wants to purchase one Bitcoin, they will press one Bitcoin and click buy, and the price will the executed price will go through the books until that order is complete. So if there was no other orders ahead of your 33,699, then you would sell your Bitcoin to that person and they would buy it. Okay, it can get more complicated than that, but that's basically what it means. And the difference that you want to be aware of is that market orders generally open up the opportunity for slippage, and they're more expensive in terms of fees. Okay, what slippage is the difference in the price that's quoted and the price that you actually get when you place the order. Because there are transactions happening all the time, You can see on the right hand side here, these are the current trades that are going through. So every second really, there's more trades coming in. So you might see 33,710 and you might press, okay, I want to buy 1 Bitcoin. But by the time you click that and it goes through, there's going to be a number of other people have also bought it. There's going to be more orders getting added to the book and taken off the book all the time. So you won't know what price you got until you actually go and check on your order history, and it'll show you the exact price that it was executed at. That's the risk, and that's one of the downsides of a market order. So this one, so if you use a market order, it means it's going to take just whatever price is available. All right. So to get around that, or if you wanted to say, no, I only want to buy Bitcoin if it's at 33, let's say 33,697, then you can specify that 33,697 limit order, and you can put in, say, 1 Bitcoin, and then you press position, okay, or press buy, and it would put that then onto the books, and it would allow you to place that. Let me actually show you. Since we're not using any margin here, we're no leverage, I've just got a separate test account here. So I'll put in the amount that I have in it. Okay. So let's say I think price is going to go along here, right? So I don't want to buy it up here. I want to buy it, let's say, if it goes down to, let's say, 33. It's a bit high for me today. I don't want to actually purchase it at 33,687, so I'm going to put it on the books here. So you press buy, you put in your amount, and you click buy limit order, okay? And that will put that order in on the books. So if price comes down and hits that level, it's going to fill your order, and then you'll have that, that number of Bitcoin purchased at that price. Okay, I'll just cancel that. When doing that, you can also set targets for profit and stop loss. So if you wanted to buy it at 33,000, sorry, like I said, you put it in here. You also want to set where you want to sell and take profit, or sell and stop as a stop loss. If it goes down, you can do that here as well. So that's just by, like I'd sit there, just go into the advanced order tab. You've got limit 33,000, and then you want to just put in what profit you would like to take that at. So say you want it to go to 34, and then your stop loss, you say that's 32. So that's obviously a 1-to-1 risk to reward. So you're risking, you're putting in your 2,000, and if it goes up to 34,000, you're going to make 3%. And if it drops down to 32,000, you're going to lose around 3%. So you're basically saying, I feel that if it goes to 33,000, it's going to go to 34 before it goes to 32. And you place that. It shows you what your profit would be, what your loss would be if it stops out. And then you can place that order. It'll put it on the books like this. And I'll just zoom out a bit so we can see. All right, so that's what it's going to do there. It will go here. It'll get placed if price reaches that, it's going to buy your Bitcoin, and then it'll take the profit here if it goes up. And if it drops all the way down there, it's going to sell it and stop you out. Okay, so you just close those. So that's the basics of how to buy and sell, and what the order differences are. So limit versus market. Then there are a number of different orders based upon other actions that you want to take in the market. Okay, so these are important to understand and important to know what they mean. So we'll go through them in order. So you've got a stop order. Okay, so stop doesn't mean that it doesn't just apply to price going down. A stop can also be used for price going up. So if you place a stop buy order, can see here, if the market rises above the trigger price, a market order will be sent. And similarly, if you place a stop sell order, if the market drops below the trigger price, a market order will be sent. So let's look at it simply. And if you thought the Bitcoin price was going to go up and you wanted to buy it on a breakout, you would put a stop market order at whatever level it was. All right, 33,973, let's say. And you place that. That puts the order here so that you can buy something higher if you want to. I'm not saying that we recommend this at all. It's not a type of trading that I do. But if you did want to buy something higher, you place a buy stop. You might be thinking, why wouldn't I just place a limit order? Because the limit order we covered before. Well, a limit order will actually buy up to and sell down to. What that means is if you place the limit order at 33,973, it would actually just place the order immediately at the best available price. Okay? A limit order for buying only comes into effect if it's below the price. It'll only sit on the books if it's below the price. You can't put a limit order in above the current price. If you do, it's just going to convert it into a market order and give you a fill at the current price. Okay? That's why you would use stops if you want to trade outside of the current price. So that's a common one that catches people out as well. So be careful with that, because if you place a limit order incorrectly, it's going to give you a price that you didn't want. So if you wanted 33,973 and you place the limit order, it's going to give you 33,654, and it's going to put it through as a market trade, which is going to cost you some fees as well. And then you would have to reverse that and sell it, which is going to cost you more again. So be careful with that one. It's not a trade. It's not an order type that you should be using much anyway, in terms of stop trades. But limit trades, just remember, if you're placing a limit buy, always goes below the price. If you're placing a limit sell, it always goes above the price. Okay, because on order books, there's there's sellers above and there's buyers below. Stop limit is a bit more complicated as well. I'll cover stop market just and show you the sell side of it. This is the most common use for a stop market order. It's just like we had shown on the initial in the order a minute ago. A stop market is when you want to place a trade below the current price or below whatever price you're in, to stop the trade if it goes too low. Okay, so it's at 33.4. It's not going to let me place it because this is a sell order on spot, so I would have to borrow the amount. So it's not going to allow me to trade it unless I click margin. But a stop market order would essentially, if it was 33,400, it would put an order in here, okay, which would, if triggered, would sell your Bitcoin. Okay, so it's basically for protection. It's a stop loss. Then you could stop limit, which is the same idea as the stock market, but it just means you can set a limit order. So it means that you become on the other side of the trade. So instead of just triggering and taking a market order, it would trigger and allow you to place a limit order. Okay, so the reason you would use this is that, let's say the price of Bitcoin was to go down to a certain level, and you think, okay, if Bitcoin goes to 33,400, I then want to place a limit order that if it reaches, say, 33,500, then let me see, 2,000. Like that. And margin on for now. That would mean that if price comes down and touches 33,400, it's going to place a sell order at 33,500. Okay, so you would use this if you think the price is going to drop, hit a certain level, and then rise again, and then drop again. So it's quite a complex order type. It's not something that you need to be concerned with, but I want to go through them all because they're here, and just so you're aware if you do ever want to use it. But it's probably not something that you need to be using. It's quite an advanced order type. But you can see here, if the market price falls below the trigger price, a limit order will be sent. Okay. Generally, you're going to set that limit order above, because if it hits this level, it's going to bounce up and then trigger the limit price, which means you can put a limit order on and basically pay less fees and add an order to the books. A trailing stop is an option for price to a stop loss, let's say, to follow behind the price. So if you were placed a long trade or bought some Bitcoin, so you bought it here, 32,183, and then suddenly it blasts up like this, and you're up over 33,600, 700. When the price is here, let's say, this is a good example where it's sitting now, and you think, oh, okay, well, price might continue on up to 34 and above, or it might pull back. So my entries here, I want to place a trailing stop so that if Bitcoin drops back by a certain amount, it triggers my stop loss and I close the trade. Okay. And what you do then with the trail value is you have to put in the number of dollars behind the current price that you want to trail it. So let's say it was $100. If you're using a sell stop order, it needs to be negative. So it wants to be minus 100. All right. And let's say it was 2000. Then that means if you had placed this order and we're at 33,636, it's going to automatically calculate $100 off that. So 33,536. And it's going to place your trailing stop loss there, which means if price then hits that level, it's going to sell your Bitcoin. If price goes up, then it's going to recalculate that trailing value every time the price makes a new high. Okay, so I'll just talk through the description here, which I've just said, but I'll cover it again. Trigger price of a trading stop order moves with the market price. It starts at the market price minus the trail value. Each time the market price rises to a new high, trigger will update the new price minus the trail value. If the market price reaches the trigger price, meaning it's fallen by the trail value, a market order will be sent. Okay, so every time price makes a new high after you've placed it, it's going to update that trailing stop and then basically keep you constantly in a position where you're never going to lose more than whatever number of points you had set for your stop. Useful if price is breaking out, let's say, and it's going up on a really fast move and you're unsure of, you don't know when it's going to pull back. You're in profit and you want to make sure you lock in some of that profit so you can place a trailing stop, especially if you're not going to be near the computer, you're not going to be trading it, you're not going to be actively looking at it. The trailing stop can be useful for that, just to make sure that even though you're not there to manage the trade, that you'll still be safe for locking in some profit. Take profit orders are fairly self-explanatory. If you have a take profit sell order, it's an indication that you want to put an order on the books to sell your Bitcoin when it reaches a certain price. Okay, so if you think I've bought my Bitcoin at 2,000, say you've bought it at 33,600, and you say, okay, well, whenever it gets to 34,600, I want to take profit. All right, so you put that on the book. You ignore this. I'm only doing it for example purposes. That box wouldn't come up if I actually had bought Bitcoin first. This is so you won't see that box if you actually own the Bitcoin, and you shouldn't be placing these trades unless you own the coin. Okay, so that means that if price goes up here, you want to take profit. It'll sell your Bitcoin for you and lock in the profit. That's how take profit works. Again, works the same the other way around. If you're doing a buy take profit, that means you're gonna take a buy order whenever price drops down to the level, and that's if you're shorting, obviously. Shorting, we're going to come on to in a second. You shorting and everything, that's done through the perpetual futures, but I'm just showing spot trading at the moment. And take profit limit is the same as the stop limit that we had touched on before, where you want to set an order in the books that if it triggers a certain price, then it puts a limit order at another price for you to take profit. Okay, so if you were, again, you'd bought Bitcoin and you're trying to sell it, that means that you would trigger the price at a certain level, and it would then put a sell order above that, so that you could then take profits. But again, those, it's not that important. In my opinion, it's much easier to just stick to take profit, stock market, limit order, and market order. You don't need to, play with stop limits, take profit limits, or trading stops. Really, you should have a defined entry, risk, and profit target, and just stick with those. All right, so next part we'll do is we'll go to leverage. We'll talk about leverage, and then we'll talk about how to short. And let me see. Yeah, I'll do this. I'll do them in different videos. Just want to make sure these are fairly short.
Hey guys, how are we? Crypto Dan here with a quick tutorial on using the Dan's Ultimate Hunter Algorithm system. Now, I originally had a longer tutorial, but I realized that for you guys to implement this system, I need to keep it really simple, short, and sweet. So this will just be like probably a 5 to 7 minute video covering the absolute basics of what you need to do. You don't need to know anything else besides this video. You don't need to know how the algo is coded. When roughly the signals will come. All you need to know is when to buy, when to sell, what to sell, where to find out where to do these things, and where to send any questions that you have. That's about it. So that's what I'm going to cover in this video. But before we start, I need you to understand that this is the single most accurate and also simple to follow investing system in crypto. You've discovered an absolute hidden gem of crypto. Like, this system has not been made anywhere else. I designed this myself. It's based on 4 years of crypto experience, and it is genuinely the best investing algo out there. So when you watch this video, just know that you've stumbled across liquid gold, and you need to make sure you use this algo accordingly. It is the best on the market by far. So with all that hype out of the way, what is it actually for? So the Hunter, this algorithmic system is basically designed to make it incredibly simple to buy cryptos near the bottom and sell cryptos near the top. It works on 90% of coins in the market. Some coins it doesn't work on, but we can cover that in a later part. But basically, yeah, 90% of the coins in the market, it works incredibly well to buy the bottom and sell the top. And the concept of this algorithm is to simplify your crypto investing with a proven system that actually works and delivers.
This is an overview of the different products available on FTX. So when you open your account, let's say you've started from scratch and you're brand new to cryptocurrency, and this is your first account. So you'll open your account with the exchange, and you'll obviously fund it. So you'll add in some either crypto or dollars or whatever currency you want to add. Then you would trade it. So you want to obviously buy your first bit of cryptocurrency. So the way you're going to do that is through the spot market. So there's spot and then there's futures. They're the two that we're going to talk about today. Any of these other products, if you want to research them yourself, you can, but we're making this guide as a base for people who are less experienced or new or fairly new to crypto or at least new to using FTX. So we're only going to focus on the spot and futures markets because they're really all that you should worry about until you're a bit more experienced. So spot is basically where you take the actual delivery of the product. Okay, so you take your US dollars in this example. Let's say we're looking at the Bitcoin USD pair. You take your US dollars and you swap them and you get given Bitcoin. And the Bitcoin goes into your wallet on FTX and then you can use that. You can transact with that Bitcoin. You can send that to, you can withdraw it and put it into a cold wallet if you want to store it. You can send it to other people. You can use it to buy stuff. That's what a spot market allows, is actual physical delivery of the product. Okay. So that's the one that we recommend. That's what you should use. That's where you should start, and you should always trade or transact in spot. For as much, basically for as often as you can until you feel comfortable using other products. So the other products that I mentioned are futures. So futures traditionally are, they're not the real, so they're a synthetic contract, okay? So a future is not, you don't get the Bitcoin, let's say in the Bitcoin example, like you don't get any Bitcoin. You can't send it, it doesn't go into your wallet, you can't transact with it. It's actually just a contract which is cash based. So generally on FTX, it's US dollars and it's all cash based. So you're basically buying and selling or going long and short versus other people or with other people on the platform. So if you say, I think Bitcoin's going to go up and you purchase a futures contract for that, then somebody's on the other side of that selling it. And the difference in the two is basically whether you make profit or not. And the profit or loss that is realized is always in US dollars. So you have different types of futures. You've got dated futures. So like this one you see here, Bitcoin September 2021. That means the contract expires on the 24th of September. You can see there, 0924. That's the date that it expires, and the trades that you make are based upon that date. So the price of that contract is based upon what the market thinks Bitcoin will be worth on that date. Okay, you can see that it's over 34,000, even though the regular price of Bitcoin is, just over 33,600. So that premium or that difference between the two is basically the funding, or not funding. The difference in the two is kind of the premium you have to pay to be able to purchase that Bitcoin in the future. If the premium is higher than the current price, which it generally is in crypto, it just means that the market has an expectation that prices are going to rise. Okay, it's as simple as that. In traditional markets, this would mean that on the 24th of September, that you would actually, if you say were to purchase that contract, then you would take delivery of that Bitcoin on that date. So that means that somebody is selling it to you, and they're happy to sell their Bitcoin to you on the 24th of September at $34,093. Okay, it's it comes traditionally from commodities where it's say there was wheat or grain or oil or whatever it may be. People would buy those futures, buy those dated products because they want to lock in the price, and it's generally used as a way of hedging in traditional markets. Or if you are, say, like a farmer and you sell wheat, you want to sell those futures at a certain price so that you can protect yourself against whatever, if there's bad weather or things like that. And so the equivalent of that in crypto is basically to have these dated contracts. They're not really something that we recommend that you use. There's no real need for you to use them. They're more of a sophisticated product for certain types of investor. If you're just trading on spot or perpetuals, which we'll talk about now, that's more than enough. But I wanted to just clarify what those dated futures are, just so you're aware. The other part, which I just said, was perpetual futures. And a perpetual future is, it's the closest thing you'll get to a spot market without having to physically transact the cryptocurrency. It's a specific type of futures contract, but unlike the dated ones, it doesn't have an expiry date. So hence the word perpetual. You can hold this for you can hold it for as long as you like. There's no expiry date that's going to come up and close the contract. And the price of the perpetual is based upon the underlying index price of the spot market, plus or minus the difference in the amount of contracts being traded and whether more people are trading long or short. So when you go to perpetuals, the difference in a Bitcoin at the moment is it's very, very close. So you can see on the right-hand side here where the index price is 33,632 and the market price is 33,633. So it's actually almost exactly flat. Generally, there'll be a small difference in those two prices, and the difference in the prices is dictates whether the market thinks the prices are going to go up or down in general. Okay, so that's how the funding rate is calculated. You can see there the predicted funding rate. The funding rate is the equivalent of the premium on a futures dated contract. So, in the previous example where a September contract of Bitcoin was a few $100s higher than the current price, that's the premium you're paying to secure the price of Bitcoin, or to secure that Bitcoin, on that date. Well, because a perpetual future never expires, that is broken down into a funding rate, which is charged every hour or every 8 hours or every 24 hours, depending on the exchange. All right. On FTX, it's paid every hour. So once for holding a contract open, you either have to pay for that or you get paid for holding the contract, depending on what side of the trade you're on. So if funding is negative, like it is now, you can see there it's on a minus, now very small percentage, but if it's negative, that means that more people think that the market's going to go down than up. And that means that if you are holding a short position, you then have to pay the counterparty who's holding the long position for holding that position open. Okay. And vice versa, if the predicted funding rate is positive, so it's above zero, then the market thinks that the price of Bitcoin is going to go up over the medium or kind of near term. And that means that if you're holding a long position and you're on the right side of the market, essentially, you have to then pay the shorts who are on the wrong side of the market, essentially, for holding the position open. Okay, that funding rate is taken out of your balance automatically by FTX every hour, and you can see that in your. You can go into a trade history, and you'll be able to see how much funding that you've paid. And another thing to note, an important thing to note, is that funding rate is based off the position size that you're trading. So, it'll get into it if you use leverage more so, which we don't recommend right away, but I might as well cover it. But let's say you were using leverage, and you had only, like in this instance, you had $2,000 in the account, but you were putting a position on that was worth $20,000, so it was 10x leverage. You have to be aware that you will pay funding rate based on a $20,000 position size. Okay, so funding rate is charged on the total notional size of your trade, not on the amount that you actually hold. So it can get very expensive very quickly, and this is again one of the pitfalls of leverage trading, where you don't actually have that money, but you are paying your fees based on that. The fees you pay to trade are based on the notional value of what you're trading. It's not based upon the actual amount in your account. So if you're benefiting from 10x leverage, you're also having to pay FTX and pay your counterparties as if you are trading at that size. So that's just a bit of a side tangent, but that's important to note on perps, perpetuals. And that's another reason why trading on the spot market is much better, and is all we recommend for the first while. That's everything basically on spot and perpetuals that we wanted to cover. I'll go into some other videos now covering how to trade, how to place trades, how to short, and everything like that. So cover that now. Thanks.
So you want to trade Forex. Welcome to the Hustles University 2.0 explanation on how you're being exploited by the retail brokerage industry. Let's have a look at why people want to trade Forex. It's a great lifestyle. You can trade from the beach and make good money. Forex market trades trillions of dollars. I only need to take a tiny amount of that and I can get a full-time income. Regular people are doing it, so can I. Lots of opportunities. The market trades constantly, so I can work when I want. I know a guy who does it as well. Leverage means that if I get good, I can scale up and make millions. Now let's have a look at the Forex agenda. Forex traders in social media, seduction via nominal volume, market participation and volatility, technological and algorithmic competition, psychology and tunnel vision, and mathematical reality. Guys, we're going to be covering all of this in the upcoming presentation. If you've ever had the desire to trade Forex over any other asset class, I encourage you to absorb all this information. I put a lot of effort into this one. I'm very passionate about this argument, so let's continue. If you've been on social media before, this is the type of typical shit that you're going to see. A lot of Forex accounts flexing wealth and flexing lifestyle as well. You'll see a lot of this type of posting. And this is super, super seductive to normies. The fake Forex trader lifestyle is all over social media, and it's the easiest thing in the world to fake as well. You can hire some cars, go to a nice location, take 100 photos, and drip feed them out over months. Forex posers do it constantly. And if I'm being fair, rich people do it all the time too. It's a valid, social media strategy. However, when we're looking at it through the context of why you become interested in this in the first place, people can hire a Lambo for a couple of hours, buy a stack of fake Hollywood money online for only a couple of $100, and just take shitloads of photos of it. It costs even less to take your shitty MacBook to the beach and take a picture of it. And this is one of the main ones that I see people getting seduced by all the time because it plays on people's humility. It's like, yes, maybe I don't want the Lambo, but it would be nice to just escape work. If you're the type of guy that's going to work all the time, you're like, oh, I just want to escape the rat race. No. Earn from the poolside only with a phone or pictures of laptops on the beach is like crack cocaine for retards. This is the professional trader reality. And it is literally this for 16 hours a day for 5 to 10 years straight. If you want to become a professional full-time trader, you must completely become a degenerate when it comes to investing and trading technique and screen time. The amount of education that you need to put through yourself, you need to be a self-starter, and you need to be fully dedicated to being in the seat at all times. This is the reality of trading. There is no beach. There is no phones. There's only pure suffering. But wait, it gets worse. Think about the incentive structure for these Forex influencers with their affiliate links. It's usually in the form of IB agreements, introductory broker agreements. This is where they get commissions on your investing and trading activity, which is a massive conflict of interest, because they're quite literally paid on the volume of fees that people generate from pressing the button, which is typically why there is a strong emphasis on day trading. Can you start to see why? The more button presses that they can get you to make means they get more affiliate commissions in a shorter amount of time. But I hear you ask, what is inherently wrong with day trading? Buckle up, because we're about to get started. We're just getting started. But first, let's have a quick look at seduction via volume. This is a classic one that I hear all the time. Forex markets are trusted because they've been around for so long and they trade such high volumes. If I just get involved and I take a little bit of money, then they won't notice that it's missing. I'm just like, a little squirrel, just jump in, grab a couple of little morsels, get straight out. I mean, look at this, $6.6 trillion a day. In 2022, down the bottom, you look here, almost $2.5 quadrillion of annual volume. Not too bad. Makes you think to yourself, well, shit, why don't I get involved in that? Seems like that's where the money is. Wrong. Jesus Christ. Volume numbers don't mean anything. But I only want 10K a month and the Forex market trades $2.5 quadrillion annually. I'm so humble. No. 2.5 quadrillion isn't the amount available to be taken. It's just the transfer volume. That's it. It's not like you can deposit your money in a bank and be like, oh, yeah, but my bank transfers $1 billion a day. Therefore, if I put my money in the savings, they might give me some of those billions of dollars. No, it completely does not work like that. This is such a basic logical fallacy that I'm perplexed that any human could even fall for it. And I've seen this dozens of times. One of the quotes that haunts me was somebody just said, yeah, but it's like a big river of money. I just need to dip my cup into it and take out what I need, to be humble. No, fucking idiots. But wait, it gets worse. Yes, it gets worse. More volume, which equals more liquidity, which means it's harder to move markets with volume. This means lower volatility, which means fewer opportunities over time, which means people need to go down into lower time frames to extract moves. Over like the minute and the second time frames, people seem to be obsessed with these low time frames because the volatility in forex markets are usually so low. This is quite literally equal to people being herded into the high-frequency trading algorithmic meat grinder like cattle. Yes, this is you down the bottom, and yes, the Terminator is eating your stops. You have to understand the technology that you are deciding that you want to be put up against. There exists in all markets an army of Terminators in the form of institutional-grade investing algorithms. These programs have one job, and one job only, and that is to exploit any and all market participants to the highest degree possible at light speed. Every possible game theory application, every obscure behavioral data point which can be leveraged is run through artificial intelligence systems which can simulate and optimize trades against every market participant in the world at 100 million times per second. Every hedge fund hires doctorate-level mathematicians, statisticians, game theorists, and financial geniuses to design these perfect killing machines in an algorithmic race to zero. Zero being when there's no more market edge to extract. You cannot comprehend how fast these algorithms are, nor in what creative and incomprehensible ways they're exploiting you. The Forex market is their favorite because of this high liquidity. You have to understand, Forex market participants are mainly financial institutions, hedge funds, investment managers, multinational corporations, as well as commercial investment and central banks. Do you really think that you have a chance against these behemoths who have spent billions of dollars in research over decades to kill as many other people in the market as possible? You have to understand the reason why we're so tunnel visioned on crypto is because we want to escape this competition. And people that want to trade Forex are implicitly choosing to make the game harder for themselves. The lack of liquidity in crypto markets is what makes it an oasis for retail traders before the integration of institutions. We're trying to get as much money as possible before the game becomes hard. So this is where the psychology comes into it, where tunnel vision and illogical outlooks seem to propagate. The wrong outlook is that I want to make money trading Forex. The right outlook is I want to make money and I will go where the money is. Uninformed tunnel vision on a single market will not make you money. Only an analysis of the total playing field can do that. My tunnel vision on the cryptocurrency market is coming from an informed position after several years of actively comparing and contrasting different markets. Can you claim the same? Literally ask yourself, what experience do you have in comparing and contrasting different markets, doing like deep analysis on this stuff? This same analysis is why I used to make money in the commodities, make more money in commodities than I did in Forex, stocks, and bonds combined before crypto became mainstream. I didn't care what market I traded, as long as I found the right edge to make money. In Forex, there is no edge. And I hear this one constantly as well, but I know a guy who does it. No, you don't. Everybody knows somebody who does it full-time. Trust me, I've known plenty of them who flex the lifestyle, post shit all over social media about how smart they are. They share their analysis, their little screenshots of their P&Ls on random days. When the time comes to share P&L on demand, or when you hit them up 12 months down the line to ask them how they're doing, they have 100 excuses. They all fail. This is a statistical fact, and it's akin to telling me, I know a guy who makes full-time income playing at the casino. No, you don't. Can you comprehend how transparent these lies are? If you still don't believe me, should have removed that slide. Sorry, guys. Still don't believe me. Excellent. Time to unleash my final technique. Raw mathematical truth. Let's fucking go. Recognize these models? I didn't think so. If you did, we wouldn't be having this conversation. The normal model is one of the most beautiful models in mathematics. It represents the probability density of a series of data points. Not all data series fits the normal model. Only random and naturally occurring phenomena reliably fit, such as the height of trees, solar radiation reaching Earth's surface on an average day, a person's finger length, or the fucking price return series of a financial market. Now, I'm going to show you a couple of different examples. As you can see, these are random, they are inherently random, but return distribution samples over different time horizons. We have half an hour, 60 minutes, 240 minutes, 1440 minutes. And take a good look. Just chill with this for a minute and just have a good solid look at these price returns. Notice anything similar to all of these? How the mode is at 0. These are the mode, the median, and the mean are all equivalent to the average returns, the center of this probability distribution. And you can see how they all center around 0. Now, does this not tell you about the characteristic behaviors of this market and the return price series? Look, even if we get a return price series, a probability distribution of something where we're trying to get an edge in the market. This is just an example, by the way. You could do this for any type of statistical edge that you're trying to find in the market. This one just happens to be based on bullish engulfing candles. Look at where the median and the average is. 0. They're all at 0. The average returns are 0. You can look at the skews and say, well, there's a little bit something going on here. Can you see how symmetrical this return distribution is? This is another one that I pulled from the OddJPY, pulled it off Google as well. But actually also take note, this is also an important one I almost forgot, take note of the frequency. Take note of the frequency. 7,000 samples of just that one bar. And then 7,000 samples of the next bar, and the next bar, and then we go down to 6,000 samples here and here and here. There would be hundreds of thousands of samples in this one study here. And then we can look at this same one here. This is a good example. Frequency, we have what we would imagine to be a statistical edge, bullish engulfing patterns and bearish engulfing patterns. And we can see that the mode here is very, very close to 0, where this dotted line is. And you could make the argument that there is some sort of edge here, and that there is something in the Forex markets that you can extract out of each of these different techniques. But look at the frequency. Look at the frequency. This frequency is for each little point on this curve. There are thousands and thousands and thousands. There are tens and hundreds of thousands of samples in each of these distributions. Now, if you're going to try and tell me that yes, there is an edge and I'm going to trade bullish engulfing patterns, in what universe are you going to sit there and place 10,000 trades and receive an average return of 0.05% and then tell me that you want to be a successful Forex trader using one of these different techniques? Fuck off. But the technical analysis, this one's great. People believe that their squiggly lines do something. Technical analysis is astrology for men, deluding ourselves into thinking that our chart finger painting has any sort of significance whatsoever is a thought crime of the highest degree. Worse yet is the classical practice of setting the risk-reward targets at a 3-to-1 ratio, which is commonly taught. If the market has a normal distributed return profile and you place the stop loss 3 times closer to the mean, the probability of getting stopped out is like 20 times higher due to the kurtosis of the distribution function. Kurtosis being the shape of the distribution curve and how fat and skinny the tails are relative to the body of the distribution. Let's really look at this. Probability density. look how high up the interception is between the stop loss placed at 1 versus 3 over here. You really think that your take profit's going to get hit when it has a probability density of virtually 0. Literally think about the statistics of what you're trying to achieve when considering the very realistic fact that there is no edge. And you're telling me that with a 3-to-1 risk-reward ratio, where your stop loss is 20 times more likely to get hit, that you're going to make money out here with a probability distribution of essentially 0? Not a chance. But ultimately, you don't even have to trust the theoretical analysis when the killing blow serves itself. There has been research which shows that 99% of Forex traders fail to make profits for more than 4 continuous quarters. Trade Forex for a year, you think you're going to make an annual income from it? Get real. Absolute pure delusion. With that being said, let's have a quick think about some genuine methods, being realistic here, ways that you can make money in Forex, and some of these ways that I have seen them done. You can use market regime analysis with portfolio allocations. So this is more of a long-term time horizon based method on a month-to-month and quarterly average return basis. You can extract the probability and average return profile for things like the US dollar. US dollar is probably the main one here. If you pull out the percent positive ratio and the average return from the US dollar during different market profiles, regimes, you can actually get a decent edge there, and you can trade it over a month-to-month basis. But like I've mentioned before, due to the intensely high liquidity of the Forex market, the probability of making any decent money out of the Forex market just holding a long only or a short only position, cash position, man, you're in the single figure percentage points, maybe in the double digit percentage points, but even then, you're trading on something that is inherently kind of drifts up and down. It has no inherent edge in there. So your analysis needs to be on point. Your market regime techniques need to be locked down, and you have to have very good quality data. So you can do swing trading based on opportunistic macroeconomic events. So we can look at news kind of stuff like recessions, war, sanctions, resource boom and busts, and monetary and fiscal policy differentials. That one needs to be front run a bit. That one involves a fair bit of data. The resource boom and busts, you can do that as well quantitatively. I would recommend doing all of this stuff quantitatively, use as much data as possible. And you can go short-term trading using algorithms. Non-discretionary only quantitative research on a deep level you need to do and learn multivariate regressions, probably AI, machine learning, and then have like server farm levels of backtesting and genetic optimization on a regular basis. If you're going to be going into the short-term realm, it's absolutely possible. There is alpha there that the hedge funds don't really care about, like alpha that's filthy, that retail traders kind of can mop up for themselves. But at the end of the day, are you really going to be spending weeks and weeks and months designing and then maintaining these algorithms when you could be doing something else? Like in a market that has a tailwind essentially that runs in your favor at all times and has low institutional participation to the degree where it makes the alpha more available for retail traders. Look, are any of these methods worth it for the time investment relative to the other opportunities that you have? No, not really. So not when you have access to less competitive markets with higher returns. So I say don't suffer for no reason, invest in crypto. And on the right hand side, this is my basic opinion. Don't let this be you. With all that being said, thank you very much for listening. If you have any further questions, please don't hesitate to hit me up. Professor Adam on Discord. So thank you very much, guys. Talk to you soon.